this earnings reporting season, it's all about NIM, it's all about loan growth, it's about expense cutting, those types of things. So really these regionals, that's really going to start to kick in, and smaller banks really next week. But what we've heard so far is, some of these larger banks, you mentioned one, their net interest income, these guys are trying to figure out what is going to happen. Are we going to have one Fed rate cut? Are we going to have two? Are we going to have three? And so I think that, in these bigger banks, that's just one of many, many moving parts. But certainly it's important. But I think you're coming down to a few basic issues. Certainly the Fed and what the Fed does is going to have a big impact on what's going on with the financials and loan growth, as well as just economic activity as well, as we come down the pipe here.
Yeah, I mean, Josh, we talk about economic activity through the lens of freight and transports, but banks are the other sort of big indicator of where we're at right now, right?
So it's hard to say that and then not consider how much lending activity is happening in shadow markets that are not captured by regional banks. You've got all these players, whether you're talking about venture-backed companies that are now doing loans, you're talking about private equity or even hedge funds that are now in the business of putting loans out. And then you look at these deposit institutions that don't have a lot of the things consumers want. They don't have cutting-edge technology. They don't have mobile apps. And so maybe all of the activity that's happening isn't being captured just by what these companies are saying. I think construction loans are very important for regional banks. That's absolutely true. But I think there's a lot of consumer lending that's happening away from them now. And again, that's a different generation. So I think you want to think about financial services in its totality. You look at what the big Wall Street banks had to say. A lot of them are dipping down into more consumer business, even Goldman Sachs. There's so much happening in lending away from the regionals that it's tough to say, yes, this is the whole story based on what Synovus and Signature Bank are telling us.
Right. Scott, we're getting into earnings season now. We got a couple of big ones after the bell today. How would you rank things so far, and what are your expectations as we sort of get deeper in here?
Well, David, I think when you come in, and if you look at the consensus was down, 2-3%, something like that coming in. We're not making a bold call here. We think it'll be closer to flat. That's what we're looking for in the first quarter. So really, the way that we're looking at it is the market's looking well beyond this, because let's face it, whether earnings are down 2% or they're up 2%, it's not a good earnings season. So, the market's focused on what's going to happen down the road. I think right now the S&P 500 is pricing in some trade positives. It's certainly pricing in, the Fed having the markets back, so to speak. Certainly not raising rates. We think there'll be one cut this year. But I think the market's looking ahead, expecting some decent things. You're starting to see a little bit of chasing here. Valuations for the S&P are not stretched, at least in our opinion. So if we can keep this economy growing at a modest rate, not have a lot of inflation, have the Fed on our side, you could see some surprises to the upside. But the 800-pound gorilla in the room is, these trade negotiations fall apart and everybody walks, the market's not going to go up on that. The risk is to the downside.